It's Brian Preston, the money guy.
Because Alex asked a great question. He said Alex was listening to Dave Ramsey. He said Dave Ramsey recently did a video on paying off mortgage early, and he mentioned risk as being a factor people don't take into account. Is it really risky to keep a mortgage for 30 years? And I've heard this before. I've heard Dave say this a number of times, that like when people talk about like the paying off the mortgage early versus not, they always fail to bring risk into the equation. How would you respond to that? Or what would you say, or what would your response be as it relates to risk? And specifically ask the question, is it risky to keep a mortgage for 30 years?
I'm always surprised when I see this question because I see it all over media and it seems like everybody thinks this is a contentious thing. I don't think it is, because I think you have to look at, this is why we put age on there. 45, pre-45, after 45. That's the dividing line. I think that your risk, because let's talk about risk. Risk for all those people paying down a 2.5% to 3% mortgage under the age of 45 is, your risk is when you get to 60 or 65 when you need the money for retirement, you're not going to have it because you used all that army of dollar bills, the explosive 88 times over, all the compounding growth you could get with those dollars is being wasted on a 2.5% to 3% mortgage. That's the risk, that you are wasting the opportunity of investing those dollars at a young age when you have the most dynamic impact of compounding growth. Over 45, your risk is, because remember, there's two parts of the equation when you're building wealth. There's getting wealthy and then there's staying wealthy. Post 45, risk now pivots. You don't have as much compounding growth opportunity. And you're also trying to figure out, how do you take just risks that face you on a day-to-day basis off the playing field for you? That's paying off debt. That's getting out of debt, because you're not worried about the compounding growth as much. Now you're worried about keeping your wealth by making sure you're paying off all your debt so that when you retire, you're truly debt-free. There's no obligations on you. That's why I'm so shocked that everybody thinks this is an absolute, it's a binary decision of 0 versus 1. And no, there's the variable of how old you are, what are your goals, and it's crazy for 20-somethings to be trying to pay off that low interest debt when they're not funding 25% towards their future and investing that money. That's a much easier decision for me.
Yeah, we just had a comment come in, Brian, and it was, hey, if you pay off your mortgage at 45, that'll give you 20 years of supercharged savings. While that's true, the problem is that supercharged savings at age 46, 47, you already said this, isn't as powerful as your dollars are at 26, 27. You just don't have as much runway. We know that for a 20-year-old, $1 can turn into 88. By the time you're 40, that $1 can turn into 7. So you want those supercharged dollars to be put into the equation when it can be supercharged. Here's another really common fallacy I see about prepaying mortgages early. All right, Brian, pop quiz. If you owe $500,000 on your house and you cannot make your mortgage payment, can they come foreclose on your house?
Yeah, of course.
Yes. If you only owe $5,000 on your mortgage and you cannot make your mortgage payment, can they come foreclose on your house?
Yeah.
Yes, right? So if the thing that you're worried about is not factoring in risk, the only time you remove that is when the debt is completely gone. Well, so from age 25 till age 45, where you're trying to rapidly pay off that mortgage, if you still have an outstanding balance, you haven't actually removed that risk until you get to past 45, until you actually get to the house being paid off. It still exists. It's not like you're saving yourself a lot if you have a $100,000 mortgage versus a $200,000 mortgage. The same risk that other people talk about is still there and present. I agree with you, Brian. I think for young people, the real risk is that you're not letting your army of dollar bills do what your army of dollar bills can do, at least in like the 2.5%, 3.5% interest environment that we've been living in.
The straw man argument is that people, they turn it into the binary decision that you're either prepaying your mortgage or you're spending the money.
That's right.
And that's not what we're saying. We're saying that you're financial mutants. There's a third option is that you're not prepaying your mortgage because you're investing that money. I mean, because we could say it's always better to save than to spend. I mean, that's an absolute that you could say, on somebody in their 20s and 30s, but it's not necessarily better to necessarily take that money that should be like in your Roth IRA versus prepaying a low interest mortgage. And look, I love being debt free because there's also the stat that wealthy people, millionaires, have their mortgage paid off in 10.2 years. I hear that stat all the time. I had it confirmed by the source, and I don't want to put too much to this, but they were like, yeah, that's something we don't talk about, but it's true. That's not their first home. This is not, I bought my first house in my mid-20s. That mortgage was not paid off in 10.2 years. The true driving factor of this 10.2 years for millionaires is that that's their second or third house. I'm in my third house right now. It will be paid off in less than 10 years.
Yep.
I fall right into this stat that they're talking about, but it's not my first house.
That's
and
right.
I think that's the fallacy that you got 20-somethings that read that stat of 10.2 years and they're like, I'm in my first home. I need to get this thing debt-free as fast as possible. No, you need to get to 25% and use the financial order of operations. Go to moneyguy.com/resources. We'll show you, and this is built in to make sure you are debt-free at retirement, but it's also paying a lot of respect to how valuable compounding growth is. I don't feel like this is a hard decision because I feel like we've come up with a system that pays a lot of respect to risk. It pays respect to compounding growth, but it also pays respect to how do you keep your wealth long term and get out of debt as fast as possible in a reasonable way. Because that's everybody always works in extremes. They're either here or there. And I'm telling you, the answer is actually a mathematical balance between the analytics as well as the behavioral side. We've come up with the solution. It's just a matter of you reading the understanding of the why and making it and applying it in your life as well.